Have you ever wondered why some people buy one house and become financially free, while others buy 3 houses and spend the next 30 years buried in debt? It isn't luck. It isn't income. And it definitely isn't intelligence. It's something much deeper. A decision made long before they ever signed the paperwork. Because somewhere we started believing that owning a house automatically means building wealth. But what if that's the biggest financial illusion ever sold to the middle class? Think about it. Banks encourage you to buy. Real estate agents encourage you to buy. Friends congratulate you when you buy. Social media celebrates homeowners. Nobody celebrates the person quietly investing in index funds, even if that person becomes wealthier. Why? Because houses are visible. Wealth usually isn't. And that's exactly where the trap begins. Today, we're going to challenge one of the biggest financial beliefs in modern history. Not with opinions. Not with motivation. But with numbers, psychology, and one simple comparison that could completely change how you think about money forever. Imagine this. 2 friends. Same city. Same age. Same salary. Same dream. Both suddenly receive $1 million. The first person does exactly what society expects. He buys his dream home. Beautiful neighborhood. Luxury kitchen. Perfect backyard. Everyone congratulates him. His family says, "You made it." Now look at the second person. He makes a decision almost everyone calls stupid. Instead of buying the house, he rents and quietly invests his money into low-cost index funds. No celebration. No compliments. No social media posts. Just patience. Fast forward 20 years. One of them owns a beautiful house. The other owns thousands of businesses. Apple, Microsoft, Amazon, Google, Nvidia, Costco, Visa. Hundreds of companies, working every second, even while he sleeps. Now here's the question. Who do you think became wealthier? Most people answer that question without ever doing the math. Because they've been programmed, not educated. And those 2 things are very different. Here's something that might surprise you. For most people, buying a house isn't their biggest investment. It's their biggest concentration of risk. One building. One location. One market. One asset. If that market slows down, their entire financial future slows down with it. Meanwhile, an index fund doesn't own one company. It owns hundreds, sometimes thousands, across different industries, different countries, different opportunities. One asset depends on one neighborhood. The other depends on the growth of the global economy. Already, you can probably feel this conversation isn't really about houses. It's about something much bigger. How wealthy people think compared to how everyone else thinks. Because wealthy people don't ask, "What can I buy?" They ask, "What can keep paying me long after I've paid for it?" That single question has created more millionaires than almost any investment strategy in history. But before you decide that index funds are automatically better, there's something almost nobody tells you. Sometimes buying real estate is absolutely the smarter decision. And sometimes it becomes the biggest financial mistake of your life. So how do you know the difference? That's exactly what we're about to uncover. To understand why, we first need to answer one question. What actually makes someone wealthy? Most people will say, "My house went up in value." But that's only half the story. Because wealth isn't measured by what you own. It's measured by what your assets produce. There's a huge difference. Imagine owning $1 million home. Sounds impressive. But ask yourself, is that house paying you every month? Or are you paying the house, mortgage, property taxes, insurance, maintenance, repairs, utilities, HOA fees? Every single month, money flows out, not in. Now compare that to an index fund. You invest once. Then, the world's biggest companies go to work for you. While you're sleeping, Apple is selling iPhones. Microsoft is signing enterprise contracts. Amazon is delivering millions of packages. Visa is processing billions of dollars. Nvidia is building the future of AI. You don't manage the businesses. You simply own tiny pieces of all of them. That's the first mindset shift. You're no longer buying things. You're buying productivity. And productivity creates wealth. Here's where psychology tricks almost everyone. People love houses because they can see them. You can touch the walls, walk through the rooms, invite friends over. It feels like wealth. But feelings don't build net worth. Cash flow does. Compounding does. Ownership does. This is known as the visibility bias. Our brains naturally assign more value to things we can physically see, even when invisible assets are quietly becoming far more valuable. It's why someone driving a luxury car often looks richer than the person driving an old Toyota. Yet statistically, the second person is often the millionaire. Because real wealth usually grows in silence, not in public. Now let's talk about something almost nobody calculates. Opportunity cost. Suppose you put $1 million into a luxury home. That money is now locked. Yes, your home might appreciate, but that same $1 million is no longer compounding elsewhere. It can't own hundreds of businesses. It can't collect dividends. It can't immediately benefit from the next technological revolution. Every dollar has one job. The moment you choose one asset, you automatically reject another. That's the invisible price behind every financial decision. And here's what's fascinating. Most homeowners never compare the house they bought against the investment they never made. Because human beings judge decisions by what happened, not by what could have happened. Behavioral economists call this the unseen alternative, and it quietly destroys millions without them ever realizing it. But don't misunderstand me. This isn't an attack on real estate. Real estate has created countless millionaires. The question isn't, is real estate good? The real question is, when is it actually the better choice? Because buying a home at the wrong stage, with the wrong expectations, can delay financial freedom by decades. And that's where almost everyone gets trapped. In the next section, we'll compare two investors year by year to see exactly where their financial paths begin to separate. Let's run an experiment. Not a theory. Not a guess. Just simple math. Meet Alex and Ben one more time. Both are 30 years old. Both have $1 million. Both earn the same income. Both want one thing: financial freedom. Alex buys $1 million home. Ben invests $1 million into a low-cost S&P 500 index fund. Day 1. Their net worth looks identical. But that's where the similarity ends. Every single day, Ben owns tiny pieces of hundreds of companies. Those companies keep innovating, hiring, selling, growing, generating profits. And every time those businesses become more valuable, so does Ben's investment. Now look at Alex. His house does absolutely nothing. It simply exists. Its value depends on factors he can't control: interest rates, local demand, employment, government policies, population growth, neighborhood development. One bad decision by the city can reduce years of appreciation. One recession can freeze the housing market. One natural disaster can erase millions. The house isn't creating value. It's waiting for someone else to value it more. That's a huge difference. Businesses create wealth. Houses mostly store wealth. And those are not the same thing. Here's where compounding changes everything. Imagine your investment grows just 10% per year. That doesn't sound extraordinary. But over decades, something incredible happens. Your money starts making more money than your actual job. Eventually, your investments earn more in 1 year than most people earn working full-time. That's the moment wealth becomes self-sustaining. Not because you worked harder, but because your assets never stopped working. Albert Einstein supposedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the principle remains true. Compounding rewards time, not effort. And that's exactly why starting early often beats starting big. Now here's the psychological trap. People underestimate exponential growth because our brains think linearly. If I double my effort, I expect double the result. But compounding doesn't work like that. It starts painfully slow. Then suddenly, it feels explosive. Which is why most people quit right before the magic begins. This is called the exponential bias. Our brains struggle to imagine how small gains become enormous fortunes. And because we can't visualize it, we often ignore it. Instead, we chase visible success. Bigger houses, nicer neighborhoods, luxury upgrades, status, recognition, things everyone notices. While the truly wealthy quietly accumulate ownership. Because ownership doesn't need applause. It only needs time. Now here's a question almost nobody asks. If someone offered you a machine that produced cash every single month, would you sell it just to buy a bigger living room? Probably not. Yet that's exactly what millions of people do. Without realizing it, they trade productive assets for lifestyle assets. And over 30 years, that single decision can create or destroy millions of dollars. But before you conclude that real estate is the wrong investment, there's one fact that changes everything. Some of the richest people in history became wealthy through real estate. So why did it work for them, while millions of others never experienced the same result? The answer has nothing to do with the buildings. It has everything to do with how they used them. And that's where the real estate trap becomes impossible to ignore. Here's the secret that changes the entire conversation. The wealthiest real estate investors don't think like homeowners. They think like business owners. And that's a massive difference. The average person buys a house to live in. The wealthy buy property to produce income. Those are two completely different games. One consumes cash. The other generates cash. Imagine buying an apartment building where tenants pay your mortgage, cover your taxes, pay your maintenance, and still leave money in your pocket every month. Now compare that to buying your dream home. Every payment comes from your paycheck. One asset supports your lifestyle. The other demands your lifestyle support it. That's why simply saying real estate made someone rich can be incredibly misleading. Because the real question is, what kind of real estate? Your primary home, is usually not an investment. It's a lifestyle purchase. And there's nothing wrong with that. As long as you understand the difference. Because confusing lifestyle with investing is where financial mistakes begin. Now let's talk about leverage. This is the reason many millionaires love real estate. With stocks, you normally invest your own money. With real estate, banks often allow you to control a much larger asset using borrowed money. That sounds amazing. And sometimes it is. But leverage works like fire. Used carefully, it builds wealth. Used carelessly, it burns everything. When property prices rise, leverage multiplies your gains. But when prices fall, it multiplies your losses too. Most people only hear the success stories. The investor who bought 10 properties and became a millionaire. They rarely hear about the investor who couldn't make the mortgage during a recession, or the landlord whose rental stayed vacant for 8 months, or the family forced to sell at the worst possible time. Survivorship bias hides these stories. We only see the winners, because the losers rarely make YouTube videos. Now compare this to a diversified index fund. One company fails, the index adjusts. One industry struggles, another grows. Technology slows. Healthcare expands. Markets evolve. The portfolio adapts without you making a single decision. It's almost boring. And that's exactly why it works. Most people think wealth should feel exciting. It shouldn't. The greatest fortunes are usually built through consistency, not excitement, not constant trading, not chasing the next hot investment, just disciplined ownership, year after year. Here's another psychological trap. People love control. Owning a property feels like control. You can visit it, renovate it, touch it, improve it. An index fund doesn't give you that feeling. You simply let it work. And for many people, that's uncomfortable. Because doing nothing feels like doing nothing, even when it's producing the best long-term results. This is called the action bias. Our brains believe taking action is always better than staying patient. But in investing, the opposite is often true. Sometimes, the smartest financial decision is to do absolutely nothing. Just keep investing, keep compounding, and let time do what no human being can. So if index funds are this powerful, why do so many wealthy people still own real estate? Because the smartest investors don't think in extremes. They don't ask, which one is better? They ask, When should I use each one? And that single shift in thinking separates ordinary investors from truly wealthy ones. Because real wealth isn't built by choosing sides. It's built by knowing exactly when each asset deserves a place in your portfolio. And that's where the strategy becomes far more interesting. By now, you've probably noticed something. This was never really a debate between real estate and index funds. It was a debate between emotion and mathematics. Because most financial decisions aren't made with calculators. They're made with feelings. Think about the moment someone buys their first home. They don't just buy walls. They buy certainty, security, status, a place to raise a family, a symbol that they finally made it. And there's absolutely nothing wrong with that. The problem begins when emotion starts pretending to be investment logic. Here's a question that almost nobody asks. If your dream house never increased in value, would you still buy it? Most people hesitate. That hesitation reveals everything. Because deep down, they're not just buying a home. They're expecting it to become their retirement plan. And history shows that's an incredibly risky assumption. Let's rewind to 2008. Millions believed housing prices could never fall. Banks believed it. Investors believed it. Families believed it. Then, almost overnight, everything changed. Entire neighborhoods lost enormous amounts of value. People who thought their homes were building wealth suddenly discovered they had been building debt. Some recovered. Many didn't. The lesson wasn't real estate is bad. The lesson was no asset is guaranteed. Not real estate. Not stocks. Not even cash. The goal has never been to find the perfect investment. The goal is understanding risk before everyone else does. Now let's flip the story. Imagine another investor. Instead of putting everything into one expensive property, she spreads her wealth. Some into index funds. Some into productive real estate. She keeps cash reserves. She avoids unnecessary debt. She doesn't chase headlines. She doesn't panic during crashes. She simply keeps buying productive assets. Year after year. Decade after decade. Boring? Maybe. Powerful? Absolutely. Because wealth is rarely built through one brilliant decision. It's built through hundreds of ordinary decisions made consistently. That's something social media almost never shows you. It celebrates the millionaire who flipped one house. It rarely talks about the investor who quietly invested every month for 30 years. and retired without financial stress. But statistically, there are far more millionaires created by consistency than by lucky timing. Here's another psychological illusion. It's called recency bias. We naturally believe whatever has performed well recently will continue forever. When housing prices explode, everyone wants houses. When stocks soar, everyone wants stocks. People chase what already happened instead of preparing for what happens next. The greatest investors don't chase performance. They chase value. They don't ask, "What's hot today?" They ask, "What will still be producing wealth 20 years from now?" That single habit changes everything. Because successful investing isn't predicting the future. It's preparing for it. And that's exactly where most people misunderstand the real purpose of money. Money isn't meant to impress people. Money is meant to buy freedom. Freedom to choose. Freedom to walk away. Freedom to spend time where it matters most. The question has never been, should I buy real estate? The real question is, will this decision move me closer to freedom or further away from it? And in the final part, we'll answer the question every investor eventually asks. If you were starting today with $1 million, what would the smartest portfolio actually look like? So, after everything we've discussed, which investment actually wins? Real estate or index funds? The answer is neither. And that's exactly why most people get this question wrong. Because the wealthiest investors don't build portfolios around opinions. They build them around objectives. If your goal is status, buy the bigger house. If your goal is freedom, buy more productive assets. There's a difference. One changes how people see you. The other changes how you live. And history has rewarded one of those decisions far more consistently. Let's go back to Alex and Ben. 30 years later, Alex owns a beautiful home. His mortgage is finally gone. His house is worth more than before. He has built equity. And that's something to be proud of. But Ben spent those same 30 years buying ownership, month after month, year after year, reinvesting dividends, ignoring headlines, ignoring crashes, ignoring hype. His portfolio continued growing through recessions, through recoveries, through technological revolutions, through companies that changed the world. Today, Alex owns one valuable asset. Ben owns thousands. Alex's wealth depends heavily on one market. Ben's wealth depends on human progress itself. Every new innovation, every growing company, every productivity breakthrough, every expansion of the global economy. Quietly, they all worked for him. Without meetings, without tenants, without late-night repair calls, without replacing roofs, without negotiating leases. Just ownership. Simple. Boring. Powerful. But here's the twist. Almost nobody expects. Ben still buys a house. Eventually. Not because he needs it to become wealthy. Because he already is. That's the difference. He buys his home using wealth, not hoping. His home creates wealth. That single shift changes everything. Most people buy liabilities first and hope they become assets. The wealthy buy assets first until liabilities become effortless. That's why financial freedom isn't about avoiding real estate. It isn't about worshipping index funds. It's about understanding the order: income, then assets, then freedom, then lifestyle. Not the other way around. Because every time people reverse that order, they spend decades trying to catch up. Here's something worth remembering. The richest person isn't the one with the biggest house, or the newest car, or the highest salary. It's the person whose assets buy back their time. Because time is the only asset you can never earn back. And maybe that's the biggest lesson from this entire documentary. The real estate trap was never about real estate. The salary trap was never about salaries. The savings trap isn't even about savings. They're all symptoms of one deeper mistake: confusing ownership with appearance. The moment you stop asking, "What can I afford?" and start asking, "What can this asset earn?" everything changes. Because wealth isn't built by spending money. It's built by giving your money a permanent job. A job that continues working long after you've stopped. So before you buy your next house, your next car, or your next investment, ask yourself one question: will this purchase make me look wealthy, or make me become wealthy? Because the answer to that single question may determine the next 30 years of your financial life. If this documentary changed the way you think, share it with someone before they make $1 million mistake. And if you want to understand how the world's wealthiest people quietly build financial freedom, subscribe to Wealth Maps. Because the next lesson might be the one that changes everything.